Have you ever wondered if the American dream is still within reach or just a broken promise? Back in the day, a high school diploma could land you a solid middle-class life. Now, young adults are facing a whole new world. Crazy expensive housing, student loan mountains, and jobs that seem to disappear as fast as new technology pops up. Not exactly the American dream everybody in the world was yearning for. However, these challenges also bring new opportunities. The digital economy allows people to become entrepreneurs, creating successful businesses from anywhere with an internet connection. Plus, the concept of the workplace is evolving with remote work, offering flexibility and a chance for a better work-life balance. Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. Let's get right into the video. The stock market's current valuations are enough to make even seasoned Wall Street veterans uneasy. But before you start having flashbacks to the dot-com bubble or the 2008 financial crisis, let's break it down the Warren Buffett style. Now, Warren's not one for fancy jargon, but he does love his analogies. So picture this. Buying index funds right now is like shopping for groceries in a store where everything's priced like it's covered in gold leaf. Sure, you might get your hands on some shiny produce, but is it really worth the price tag? Now, let me introduce to you your financial detective tools. The PE ratio and its more sophisticated cousin, the Shiller PE ratio. The PE ratio is like asking how much you would pay for $1 of a company's earnings. Right now, it's like we're all lining up to buy $1 bills for $5 each. But wait, there's more. The Shiller PE ratio, named after economist Robert Shiller, is like that wise old owl of market indicators. It looks at earnings over 10 years, smoothing out those pesky short-term fluctuations. As of 2024, it's sitting at a lofty 34.54. The last time we saw numbers this high, let's just say people were still debating whether Jack could have fit on that floating door with Rose. So, what would Warren Buffett say about all of this? Well, he's not known for timing the market, but he is famous for his patience and value investing approach. He once said, "Be fearful when others are greedy, and greedy when others are fearful." Looking at today's market, it seems like greed is having a field day at the all-you-can-eat buffet of overpriced stocks. But don't panic. Warren Buffett's strategy isn't about predicting market crashes or timing the perfect entry point. It's about finding value and thinking long-term. In his own words, our favorite holding period is forever. So, should you still consider index funds in this frothy market? Well, that's where things get interesting. Now, Warren Buffett has some priceless advice for those of us nervously watching the stock market. Let us dive into his investment philosophy before we rush to sell our index funds or stash them like doomsday supplies. Warren Buffett's strategy is simple. Buy quality stocks and hold them for the long haul. He believes in strong companies that can endure tough times and emerge even stronger. Forget about get-rich-quick schemes or the thrill of speculative stocks. Warren Buffett champions investments with solid foundations, much like his favorite cherry Coke, reliable and worth keeping. And when it comes to timing the market, his advice is crystal clear. Don't even try. This isn't a casino, folks. Predicting market highs and lows is as futile as guessing the next viral TikTok trend. He famously quipped, "The only value of stock forecasters is to make fortune tellers look good." So if you think you can outsmart the market, just know you're setting yourself up for a comedy show. Buffett is also a huge fan of index funds, loving them more than McDonald's breakfast biscuits. Why? Because they offer broad market exposure and low fees, making them a smart choice for building long-term wealth. His advice is simple. Invest in an S&P 500 index fund and leave it alone. He even bet a significant sum that an index fund would outperform a group of hedge funds over 10 years. And he won. With Buffett's timeless wisdom in hand, we can confidently navigate the stock market. Now, let's get some insights from another investment legend, John Bogle. Speaking of investment legends, let me introduce you to the guy who completely transformed the investing world. Picture this. It's the 70s. Disco is booming. Bell bottoms are in style. and Wall Street is doing its usual thing. Then out of nowhere, John Bogle steps in with an idea so simple, it's brilliant. He says, "Why are we trying so hard to beat the market? Why don't we just be the market?" I know it sounds unusual, but stick with me. He came up with something called an index fund. Think of it like a buffet. Instead of stressing over which dishes are the best, you just take a little bit of everything. That is an index fund, a piece of the entire market. And here's the kicker. John Bogle wasn't pushing a get-rich-quick scheme. He was more like that honest friend who tells you when you've had enough. He looked at all these expensive, fancy funds and said, "Why are you paying so much? For what exactly?" His philosophy was all about simplicity and playing the long game. Forget about trying to time the market. He would probably say, trying to time the market is like trying to catch a greased pig. Messy and pointless. So, the next time you're deciding where to invest your hard-earned money, remember John Bogle. Think of him as your wise, financial savvy grandpa, always dropping knowledge about patience and simplicity. And sure, investing might still seem confusing, but with John Bogle's principles, at least you're not completely in the dark. It's like he handed us all a flashlight and said, "Here you go, kids. Don't trip on your way to retirement." Now, let's talk about protecting your investments. It's like building a financial fortress, you know. First up, diversification. Don't put all your eggs in one basket. Spread your money across different sectors and asset types. If tech takes a nosedive, your healthcare stocks might save the day. Next, meet dollar cost averaging, or DCA. It's just a fancy way of saying invest regularly, regardless of market conditions. Think of it as being the Zen master of investing. Market up? Cool. Market down? Also cool. You're playing the long game here. Lastly, set those long-term goals. Investing is like planting a tree. It takes time to grow. Think years, even decades ahead. It will keep you grounded when the market gets wild. Now, let's crunch some numbers. Imagine investing $500 monthly into an index fund. Exciting stuff, right? After 10 years, assuming a 7% annual return, you're looking at about $83,000. Not too shabby. Fast forward to 20 years, and boom, $246,000. Hello, dream vacation. At 30 years, we're talking $568,000. Retirement's looking pretty sweet now, huh? But remember, these are projections based on historical data. Markets can still be unpredictable, so keep those expectations in check. So, what have we learned on this roller coaster ride? The stock market's 2024 highs might seem like the scariest peak on the theme park map. But hey, if Warren Buffett and John Bogle aren't frantically waving their arms, neither should you. Remember to embrace diversification, dollar cost averaging, and those all-important long-term goals. The wise words of Buffett and Bogle are like financial GPS, reliable and no nonsense. So you really don't have to worry that much because we have them, you know? And as always, thank you so much for watching. If you want to see more videos that will help you become financially literate, hit that like and subscribe button. And don't forget to turn on that notification bell so you don't miss out on our following videos.